Okay, so we're starting the recording. First of all, I want to say, Amanda, thank you so much for putting this together and getting me motivated to get out there and talk to you guys again about this subject. I think it's a really, really prevalent subject right now, particularly since the housing market is so hot. This opens up a lot of opportunities. So we'll go ahead and get started now. People are still coming in, so I'm just going to let them in as they come, and we'll just get started. Again, please try and keep yourself on mute unless you have a question. Feel free to ask questions at any time. I'd love to hear your comments, your thoughts, things like that, so we can dispel rumors, dispel bad myths, make sure everybody understands how this tool can really, really help you. So is everybody, if you can't see the screen that says, how can your clients use a HECM for purchase, please message me or speak up. Just make sure that everybody's seeing and hearing everything okay. So does that first screen, does that surprise you guys that you can see such a big difference between a cash purchase and a reverse mortgage purchase? So the customer can purchase a house, have absolutely no payments for as long as they want to live there, and purchase a lot more house than just by paying cash, which is what a lot of people think that their only options are. So let me see if I can make this. All right, so just a little bit about me. This is me. I'm Richard Woodward. I'm with Service First Mortgage. I'm the director of specialty lending for the company. We originate all of the reverse mortgage throughout the entire company. We have a little over 100 loan officers right now, and with the way we operate our company is that not everybody is great at reverse mortgages because they are very, very different than a traditional mortgage. So our loan officers refer them into my department, my team, and then we originate them all individually and make sure that everybody has a great experience when they're doing their purchase transaction. So again, if you're not doing these every day, then they're a little different. So the average loan officer may not have the technical skills to be able to do that. So I'm a certified reverse mortgage specialist. I've been doing reverse mortgages for about 10 years. They've changed a lot, and I like to refer to reverse mortgages as the new reverse mortgage because there is so much misinformation out there that when you're talking to your clients, talk about a reverse mortgage, you should phrase it as the new reverse mortgage, and we'll talk about those changes that have occurred. So how can a reverse mortgage help you? We have learned that if you, as the realtor, are educated on reverse mortgages, not only can you help your clients, but you can help yourself a great deal by just having the basic knowledge how it can be used and how you can leverage that tool when you're doing listings and when you're doing purchases. So the transitions are a little slow, guys, so I'm sorry about that. So in America right now, approximately 57% of baby boomers that are people between the ages of 49 and 67 say that they plan to move out of their current home during the retirement years. And that's according to a survey by Better Homes and Gardens. With approximately 77 million boomers in the United States, a significant number of people that are really wanting to buy and sell properties. So whether it's for upsizing or downsizing, relocating to another city, a reverse mortgage for purchase is a viable option for the mainstream retiree who wants to conserve their cash and live more comfortably in retirement. So there are 10,000 baby boomers, and I'm a baby boomer myself. We turn 62. There's 10,000 of us every day that turn 62. That's a huge amount of opportunity for you guys. The reverse mortgage provides access to new markets due to the current lending environment. It's conventional lending. There's no stated income hardly anymore. If there is those programs that are starting to come around, there are much higher interest rates. The reverse mortgage is a much better opportunity, and I'll show you why in a few minutes as to using some sort of what we call non-QM type of lending. And they're great for seniors who want to stay in place. Not only these might be your past clients if they're not ready to sell, but they reach out to you and desperate. Oftentimes I hear this story a lot. Their past clients will say, I just can't afford my house anymore. If they're over 62 and they want to stay in their house and moving for them is not a good option and you can't help them sell their house, then let's talk to them about a refinance as well. We're not always in it just to make a sell ourselves, but to help our clients and make sure our clients are staying in good financial position. The market is virtually untapped with reverse mortgages. I would venture to say, and I can't seem to find the chat button here, but I would love to know how many of you guys have ever been involved with a reverse mortgage for purchase. If it's in the chat, I would love to see how many of you guys have actually been involved in that. The new loan limits for reverse mortgages are significantly higher than what they used to be. They've changed now to $765,000 in the state of Texas, and we actually have opportunities now for loans in up to $3 million with reverse mortgages. So I'm just going through the chat here real quick. Seems like no one's been involved with a reverse mortgage for purchase. Well, that's good. You're going to learn a lot today. It's going to be a really good thing for you. So, reverse mortgage for purchase, excuse me, may be appropriate for borrowers that are looking to downsize, moving into a one-level property, maybe handicap access they need. They want to be closer to their grandchildren. They want to move to a 55-plus community, purchase a home that's new build and still have no monthly payments, or live in a neighborhood that's just more social or provides better ease of shopping. And medical care is a big thing for the retired community to be able to be close to that area. Well, let's kind of look at a scenario here where we're looking at a couple that's downsizing. So let's say you have a 70-year-old couple that want to sell their $500,000 house and they want to purchase a new home for $350,000, but they don't want to have any monthly mortgage payments. So in the traditional downsizing, you would sell the house for them for $500,000, roughly 8% in closing costs, and they're going to get net proceeds of $460,000, assuming their house is paid for. And the new home that they want to purchase is $350,000, so they'll get to pocket roughly $110,000. But $110,000 is not going to go a long way in today's world. So let's look at a little different opportunity with the reverse mortgage and how to preserve their liquidity. And so they're doing the same transaction, selling the same $500,000 house, still same closing costs, same proceeds, but with a reverse mortgage or a HECM for purchase, they just need to make a down payment of $169,457, and they would be able to get to net and put in their pocket $290,000. So from a client's perspective, and let's say they don't have $500,000 in the bank already, this is a great way for them to be able to fund a long and more happy retirement and have that money set aside for anything that they might need down the road. So it's just a different opportunity for them to take a look at. And if you have this knowledge, you can help them with that. That's definitely a big plus for you, and that you'll definitely get recommendations and referrals from that. Let's say that they're wanting to buy a $700,000 house, because another big thing that's going on right now are adult children moving back in with mom and dad. So you have multi-generational families now, and they just can't fit in that 3-bedroom house that they have. So they need a bigger house so that they can all live together. So let's say that same 70-year-old couple are selling their $500,000 house again, but this time they're going to upsize, or what we call right size these days, into a $700,000 home. So if they were a traditional home buyer and they were purchasing it and wanted to pay in cash, then under a traditional sense, they would need $240,000 to pull out of their retirement or their nest egg just to make that purchase happen. However, with utilizing a reverse mortgage, they can actually sell that $500,000 house after all the closing costs are paid, take out a new mortgage, a reverse mortgage, have no monthly payment, and they would get to pocket $95,800 from that transaction. So it is a great opportunity for people to upsize, still have no monthly mortgage payment, and be able to provide the housing that their entire new extended family needs. So for you, if you become familiar with a program, you can identify clients that might be someone that you might want to target. So for instance, if there's a neighborhood that's changing dramatically and taxes are going up really high and borrowers are just no longer comfortable in that neighborhood, but they only have Social Security to qualify for a mortgage on, or a small pension. Oftentimes those customers are customers that need you the most because they don't know that there's a program out there that can help them sell that house, take that cash, put half down on a new home, and you get yourself 2 transactions there and you satisfy your client's needs. So this program opens up to a lot of sales and listing opportunities just because you're aware of it. The loan currently requires minimum income, and the credit doesn't have to be perfect. In fact, I did a transaction I'll share with you here. It was a retired school teacher that was living in Grand Prairie. She had I think it was a 4,800 square foot house. She was all by herself. All of her children had moved to, I think it was Frisco or Plano. So she, like many people in that time frame, did what mothers do, and they co-signed on their grown son's car. Well, that grown son just didn't make any payments, and that car was repossessed. So that poor 82-year-old school teacher was stuck in that big house because she couldn't qualify because her credit was in the low 5s. She didn't have really enough income to qualify to purchase anything else. So what we did was we were able to help her sell her current home, take the net proceeds, put half down, buy a new house, and we even escrowed taxes and insurance for her on the new house. And she will never have a payment as long as she lives in that house. So now she's with her grandchildren in the same neighborhood, and it gives her the opportunity to be able to live a better life because you guys knew about this program and you could refer them to someone that can make that happen. So it's a win-win for everyone if the customers understand and you understand the program. Definitely opportunities out there for you. So basically, what is a reverse mortgage? I'm sure you guys have all heard of reverse mortgages, and I'm sure from what most people tell me, it's not good things. But they have changed a great deal over the course of the years, and 2017 was the most dramatic change. In my opinion, made them one of the best loan programs out there for retired couples. So a reverse mortgage is technically a HECM, or a home equity conversion mortgage. It's administered by the FHA or HUD, so it's a government-backed program. There's no payment on the loan as long as the borrowers remain in the property, stay there as their primary residence, and they pay their taxes and their insurance and maintain their home. So they never have to make a mortgage payment. They can live there until they're 50 or 150 years old. So I got a question here. So what happens to the house when the 82-year-old lady dies? That's from Cynthia. Cynthia, I would love to answer that question, but I'm going to show you that in just a few minutes. That's a very good question and one that asked by many people, which also brings up the question of, do you still own your home if you have a reverse mortgage? So let's go through the chat. Send me what your thoughts are. Do you still own the home if you have a reverse mortgage? So everybody send me a message of that. So when the customer, at the time of the mortgage, if they don't make their taxes and insurance, or they leave the house for more than 12 months, then the entire mortgage becomes due and payable at that time. And that's the only time a payment is required. So the current balance, the amount that the borrower originally borrowed, plus the interest and the mortgage insurance, is due to the lender. And so, Cynthia, the remaining amount is distributed to that client or to the client's heirs. And I'm going to show you an amortization chart here in just a few minutes that'll show you roughly how much they would be able to have in equity at the time they sell their house. So I hope that makes sense. They pay off the mortgage just like any other mortgage, and they sell their house just like any other sale, and anything that's remaining is retained by either the borrower or the borrower's heirs. Cynthia, did that answer your question?
Yes, it does. Thank you.
Perfect. Good. So why use a reverse mortgage as a purchase tool? So there's no monthly mortgage payment, no taxes and insurance are included in the payment, but taxes and insurance have to be paid by the borrower and maintained throughout the life of the loan. This is one of the big reasons why why reverse mortgages got a bad rap. So what happened in the original reverse mortgages when they originally brought them out, people could borrow roughly 80% of the home's value. Now they're 62 years old. The interest rate in that time when they originally took these out were 7–8% on reverse mortgages. So if you borrowed 80% and you had a 7% interest rate mortgage, you were probably going to be upside down pretty quickly in that loan. And that's because you're not making any monthly payment, and the interest rate is a little bit higher than it is right now. And so you accrue the interest and you become upside down. Also, what was happening in those days was that they gave them a lump sum. So they had a $400,000 house. They let them borrow, what's 80% of 400? Was that 320? They let them borrow let's say $300,000. They give them cash at $300,000. A lot of these people would spend that money in the first year. I don't know what they were doing with it, but they were spending the money in the first year. So a year comes along, they can't pay the taxes and insurance, and then it builds up a little bit. So pretty soon, the taxing authority comes and forecloses on that property for non-payment of taxes. So that's what happened when people originally thought that you just gave your house to the bank, is because they allowed them to borrow so much money, and then they couldn't pay their taxes and insurance. So of course a foreclosure happened, just like any other mortgage. If you don't pay your taxes and insurance on a regular mortgage, they're going to foreclose on you as well. So that's where most people got the misconception you're just giving your house to the bank. The great thing about the reverse mortgage too is that you can leverage retirement cash and liquidity and maintain more and more cash. I tell all my clients, if you're 62 years of age and you have a mortgage, there's no reason to have that. Get a reverse mortgage and pay yourself in a catch-up IRA. You can take that pre-tax and build a lot more wealth than if you're just paying off your mortgage. That same payment that you would have been making on your mortgage payment, you put that into retirement or a savings account, you can definitely do a lot better. And the cold hard fact is that the average American that's retiring today has less than $50,000 in savings. That's pretty scary. So by leveraging their liquidity, it enables the borrowers to be in a much better position than it was before. They can buy up and they can get the house without paying cash, or they can buy down and take out some extra cash to live on. So basically, how does a reverse mortgage work? It's really not that complicated. The older the borrower is, the more that they can borrow. But it's pretty much limited to 60% of the property's value. For purchases, that translates to a down payment of about 49% to 61%, depending upon how old the borrower is. In contrast, buyers may need at least this much of a down payment to qualify for a traditional mortgage because they don't have enough income. So they're going to be putting half down anyway just to keep their debt to income ratio in line. With a reverse mortgage, debt to income ratio is much, much easier. In fact, one person, if it's a single person, basically all we do is we take their taxes, their insurance, and any monthly payments on their credit report. We add those together. If they have more than $586 left over, then they qualify for a reverse mortgage. If they don't qualify from that perspective, because their debt to income ratio, then that's the only way that a reverse mortgage is not approved for a customer. So I have a flyer here that I can email out to everybody if they'd like to have one. You're definitely welcome just to send me a text or email, give me a call, and I can send you this flyer so that you can have that. You can give it to your customers, or you can just have it on hand so you just kind of know the basic idea. So if you look at your rows here, if you're starting at $250,000, that you'll see at age 62, they're going to need about $151,000. When they're 80, they're going to need less money because they can borrow more, so $122,000. So it's actually based upon the youngest borrower that's living, the youngest person that's living in the house. If the spouse is older, it doesn't matter. We're going off the age of the youngest borrower. And in Texas, there's no such thing as a non-borrowing spouse. So if you're married, both people have to be on the loan. That's not true in every state, but that's true in Texas. So there's another thing that's great about the reverse mortgages, and that is the line of credit. So that was added in a number of years ago. It's based upon the untapped equity in the property, and it gives the client the ability to use the equity in their property when they want and at any particular way that they want it, so that they can reduce their borrowing cost and have a built-in safety net. It grows larger and larger as long as they don't use it. And the growth rate itself is determined on these three basic factors. First, it's the current index value. Second is the margin. And then third is the annual mortgage insurance premium that's received by HUD. So even though the line of credit uses an adjustable rate mortgage that may change over time, it's helpful to know that the margin itself is the main component of it, and it's a fixed constant always and will never change. So if one buys down or pays down on a reverse mortgage for purchase, they can obtain a line of credit, and that will grow and replenish and continue to grow until it's utilized. So the growth rate is set in the very beginning, but it does adjust as the adjustable rate portion of the title, of the loan changes as well. Basically, it's available for purchases after the first 12 months. The borrower can tap into any additional equity that's there. And I'm going to show you a graph in just a second. And this line of credit continues to grow over the lifetime. So there's a technique that we like to utilize called overfunding a purchase. So this is an amortization chart of an actual reverse mortgage that I prepared today. So this is based upon a 73-year-old customer purchasing a $400,000 home. So the max claim, which is the appraised value or the purchase price, same thing, there shows you the initial principal limit, which means the amount that they actually can borrow. The borrower in this case, or the buyer in this case, wanted to put $300,000 down on this home, on this $400,000 purchase. So it was a client, let's say they're over in Garland, they sold their $300,000 home there, they got cash for it, but they wanted to buy near their grandchildren over in Frisco. So they bought a smaller house, single story in Frisco, paid $400,000 for it, put $400,000 into the loan, okay? So we're gonna finance in all the closing costs, and the customer begins the loan balance at $110,000. So if they're overfunding, that gives them an initial line of credit of $127,522 because they paid more into it than they actually needed. So this does a couple of things. It keeps their borrowing cost lower because the interest is based upon the amount that's actually the beginning loan balance. In this scenario, you'll see it's 110. The interest rate that's being charged to the customer on today's reverse mortgages, 2.76% interest rate. This is on the adjustable rate mortgage that changes annually. So the actuaries for the federal government think that the expected rate, what the interest rate will probably be, is 2.88. So in this calculation, then we're going to use 2.88. So if we look around let's go down to column 10 or year 10, okay? Now, if I were standing in front of you, I could be pointing at all of these, but I can't seem to point here. I think there's a pointer within the program, but I don't know, yeah. So here we go, year 10, okay? So in year 10, the customer is 82 years old, and there's mortgage insurance for the that year, $706. That's added to the loan balance. Interest for year 10 is $4,300. So their loan balance has grown from the initial loan balance to now $154,000 on this property. Now they haven't touched their line of credit. It's just growing and growing and growing. So it started out at $127,000. Now they have access to $178,000 that they can use anytime. If they need to put on a new roof, if they want to buy a little condo down on the beach, they can just say, call up the servicer, say, send me $178,000. It'll be in their account within the week, and then they could go out and pay cash for that condo. Or they could pay cash for their new car that they need, or medical needs, anything that they want. And that's when that line of credit, any amount that they borrow, would then be added to the loan balance. But in this scenario, you see that this customer never touched this line of credit. And at age 99, let's say that they pass away and they are ready to, their heirs are ready to inherit. So when they do, what they do is they have, at that time, they have 12 months to sell the property. Now, they have a loan balance now of $274,000 on the house that originally cost $400,000. So in 27 years, that property value has increased at if it's a 4% rate annually, that property value is now $1.15 million. So they have equity of $878,000. So in the old reverse mortgages, you tend to always lose your equity because they borrowed so much and the rates were so much higher. The new reverse mortgage, the rates are so low that the home is appreciating faster than the interest is accruing. So great opportunities here to leverage cash, have that safety net for your years to come. So I hope that makes sense to everybody. If it doesn't, send me a message or just unmute yourself. We'll talk about it, okay? So on this next page, what we're going to look at is if they just made the minimum down payment. I just don't know how to clear these out. Let's see. There we go. All right, so that's the same purchase. They're doing a $400,000 purchase, but this time they want to put the minimum down. So in this case, they're putting $172,000 down on this $400,000 purchase. And then you can see the line of the growth there. Even when they're borrowing the minimum amount or the maximum amount, their equity is still outpacing the actual interest that's being charged. And they're still growing more and more equity as time goes by. So it's again, a great opportunity. You don't lose your house. You don't have to give it back to the bank. And it's a great way for you to leverage your retirement funds. This class is a lot more fun to teach when people actually talk. So I hope you guys have any questions, just let me know, okay? So fixed rates, there are fixed rate options on reverse mortgages as well. However, and they're very compatible. Interest rates are in the 3s and 4s on reverse mortgages right now. But the problem is, if you take a fixed rate, you get no line of credit and you're not allowed to borrow as much. So you would need to put more money down with the fixed rate and you would not get a line of credit. However, your interest rate would be stable. However, if you look at interest rates over the course of the last 10 to 15 years, on adjustable rate mortgages, they've still done extremely well when compared to fixed rates. So adjustable rate mortgages give the customers more options. You get a line of credit like we talked about. You can take a line of credit and equal monthly payments for as long as the equity holds out. You can take a fixed amount every single month. You can take a combination of them. There's so many different ways if you're doing a refinance or if you have overfunded your account that you can take additional money back after closing. The great thing about the reverse mortgage is that it's a non-recourse loan, which means that it's FHA insured by the federal government. We do FHA appraisals. If something were to happen to the customer, let's say in year 10, they built a nuclear power plant behind their house and their home values just plummeted, okay? They need to sell their house or they pass away, and that $400,000 house they bought is now worth $200,000 and they owe $250,000 on the loan. So in a traditional forward mortgage, if you become underwater, you're pretty much SOL. But in a reverse mortgage, this mortgage insurance will kick in and will allow you to sell the property for 95% of the appraised value of the home by a HUD appraiser at the time you wish to pay off the loan or sell the house. So if you ever pick up a listing from a reverse mortgage and someone has a reverse mortgage and they want to do a listing and they give you their mortgage statement and it's way more than the house is worth, there's a good chance it is FHA insured and you still have that opportunity to sell that house for 95% of the FHA appraised value of the home. Then the mortgage insurance covers any negative equity. The borrower's family or the estate is not responsible for any difference. So that makes this loan much, much more secure and safe for people. And they feel much more comfortable when taking out this type of loan. So in order to find out the down payment, it's really quite easy. All you need to do is call me or text me, send me these 3 pieces of items or details, and I can tell you how much they would have to put down. It's really not a very difficult, very time consuming, so I'd be happy to do that for anyone that needs that. Just give me a call. So if you want to stick around for the guidelines on these are a lot easier than on a traditional mortgage. You can finance it up to 4 units. They have single family residences, HUDs and FHA approved condos. So the condos have to be currently FHA approved. And if you don't know how to check to see if it's currently FHA approved, all you really need to do is Google HUD condo approval, and you can pull up the list, put in a zip code or city, and it'll tell you which condos are FHA approved and which are not. Be sure to scroll all the way to the right because the screen is too wide for your monitor, and on the very end it'll tell you expired, and it doesn't show that anywhere else. So double check that. You can't do a second home or investment property with a reverse mortgage. It has to be your primary residence. And new construction is not eligible until a certificate of occupancy is issued. This is a little weird nuance with reverse mortgages. So if you're selling new construction, what we do is we get the loan pre-approved, go through credit underwrite, get everything done, but we can't order the appraisal until a certificate of occupancy has been issued. If a certificate of occupancy is not issued by the county or the city in which the home is being built, which is a very common thing in Texas, then a special inspection must be done by a licensed inspector. And I can't remember that license at the moment, but it's a very specialized license. So once we get that final inspection done by them, then we can order the appraisal and close. So we just need a couple of weeks after the certificate of occupancy has been issued before they can actually close. If it's a resale, all repairs have to be satisfied by the seller before closing. And although we do not do reverse mortgages on manufactured homes, they are eligible through some lenders. So credit, what does that credit look like for a reverse mortgage? So like I told you, I did one for the lady that was 82 years old, and her credit score was in the low 5s. So we can still get it done even if they're have very poor credit, but they could not have had any foreclosures, short sales, or deeds in lieu of in the last 3 years. There's no non-borrowing spouses allowed in Texas. So if the customer is married, both people have to be over 62 and both people have to be on the loan. Any federal lien must be satisfied, as with all mortgages. And then there's a financial assessment that must be done in order to ensure that they can actually qualify. In the old days, reverse mortgages, you literally put a mirror under somebody's nose, and if they could fog it, they could get a reverse mortgage. And under new guidelines, customers actually have to qualify. It's very easy, but you actually have to qualify for a reverse mortgage. And that makes them much better, in my opinion, because, and you won't get so many negative things heard about them, because the people that couldn't really qualify, and really, be honest with you, shouldn't be owning a property because they couldn't handle their finances, those people can't use a reverse mortgage anymore to bail themselves out or whatever they needed to do. So what is involved? So we have to have a 24-month look back of any housing debt. So if they have a mortgage, they have to have on-time payments, no more than 2 late payments within the last 24 months. We'd have a 12-month look back on revolving, so that within the 12 months in revolving, if there's 1 late payment, it could be a problem. If a borrower fails the willingness test, and that's what having good credit is, are you willing to repay the loan? Then there may be extenuating circumstances. So I've done loans where a spouse had died within the last 12 months or 24 months, and there were some late payments that were caused by hospital bills and not being able to attend. We were able to get an exception to do those. We did those loans as well. We just need to document those extenuating circumstances. If extenuating circumstances can't be provided and the customer has these late payments, they can still get a reverse mortgage, but they're subject to what is called a LISA. So a LISA is a loan escrow set aside. So in the chat, you guys are not really participating, but in the chat, or just speak out, tell me how many months do you think we have to include in the loan escrow set aside?
6 months.
Okay, I got a 6 month, I got a 12 month, buddy, another 6 month. Well, in actuality, and this is going to be a shocker, we have to put enough in the escrow account to fund the escrow account until the client is 99 years old.
Wow.
So that is a lot. So if, fortunately, some people, they're exempt from property taxes, so that's easy. But if you have, let's say you have a $4,000 annual property tax and insurance, and the customer is 62 years old, so what is 4,000 times 33 years? So that's a lot of money you have to put into that escrow account. So that can often kill a deal. So we always want to pre-qualify the customer. Just in any other scenario for a mortgage, we want to do that with a reverse mortgage as well. Any questions from anybody?
Wow, I had no idea about the escrow account.
Yeah, and again, that's another one of the positive things for reverse mortgages. In the past, a customer, again, fogged a mirror. They hadn't paid any of their debt in the last 3 years. The cars were repossessed. Their electric bills were shut off, but they could still get a reverse mortgage. So what happens if they get that reverse mortgage? 12 months down the road, they have to pay taxes and insurance. They're not paying it. Well, then the house goes into foreclosure. So the LISA, having that set up, prevents that from happening. So you'll see fewer and fewer reverse mortgages going into foreclosure than you did years and years ago. So,
Okay, so if you're getting a reverse mortgage because you want to pull some money out of equity, and then you're not that old, and you have to put all this money into an escrow account, you could possibly come out with very little money.
yes, if that happens, if your house is paid for and your taxes and insurance are not very high, it can work for you. So a big advantage would be you may not get any cash at closing, but you can live there and not pay taxes and insurance for as long as you want to. You could be 150 years old and you could still live there. But you're right. If there are credit issues that would prevent you from qualifying, you have to have a LISA. That basically just prevents a lot of people from being able to get a reverse mortgage because they can't fund it.
Oh, okay, so are you saying you only have to have a LISA if you have bad credit?
Yes, only if you have bad credit. Only if you have not, if you've missed housing payments, or if you've not paid your taxes, or you haven't paid your credit cards, only then will you have a LISA.
Okay, I'm thinking that. That's good.
Yeah, it's just to protect people that are vulnerable to foreclosure, so that they can still get a reverse mortgage. But it is a little punitive. If you have good credit, you don't want to do that, and you don't have to. But it does allow some people to still be able to take advantage of that. I mean, I have had situations like the retired school teacher. She had enough equity that she could do it and still have the LISA, so she's going to live there debt-free for as many years as she wants. Any other questions? All right, so let's talk about funds for your down payment. So it's an FHA loan, so it works pretty much like any FHA transaction, so the borrowers can get a gift from a family member. They can sell a business as long as we can paper trail it. Any deposits, it has to be in their bank for at least 60 days or more, but a gift fund does not have to be seasoned. The only real difference here with a reverse mortgage than a regular FHA loan is that you cannot use a bridge loan in order to purchase the property, because that's considered borrowed funds, and reverse mortgages do not allow that. And by the way, in this tough market, if you guys need bridge loans, let me know. I can help you with those too. We can help you close those transactions with a bridge loan. So again, down payment funds, pretty easy.
Richard?
Yes.
I'm so sorry. We do have some folks newer to the industry on the call. I don't know if you could go back to bridge loan and just give a basic working definition of that really quick, and then we can go on.
Sure, I'd be happy to. So a bridge loan, essentially, bridge loans are harder to do in Texas, but what you're basically doing is you're taking the equity from your existing house, you're using that equity and using it towards the purchase of the new house. So you're borrowing the funds to use for your down payment. Now in Texas, again, because of our equity lending laws, that gets a little complicated. However, my company, I could do several different options. There's several different ways to accomplish it. And then we have what is truly a bridge loan. So a bridge loan, we're going to put a lien against their exiting house and a lien against their new house that they're buying. And we're going to combine those two into one loan. And that enables a customer, as long as they have at least 20% equity in the two properties combined, they don't even have to make a down payment. So we're just looking for 20%. So when they sell their exiting house, then a portion of that loan gets paid off, and you're left with the loan on the new house that they're purchasing. And with this particular type of loan, it's going to need to be refinanced because it's basically a 12 to 36 month loan. It'll be refinanced into permanent financing at the new market rates after everything is accomplished. But there's a varying ways to do bridge loans, and that true bridge loan is not always the best way to do it. So you just need to have an expert take a look at it whenever you're talking about that. So any questions on bridge loans? Okay, so we'll move on. So with a reverse mortgage, the borrower can have up to 3 other properties as rental properties. They have to, but basically those properties, they have to make enough money to pay for those 3 properties as well. They also have to sign a verification of occupancy saying they're going to live in the house that they're buying. And like all mortgages, the borrower must occupy the home that they're purchasing as their primary residence within 60 days. So another really strange things about reverse mortgages, and thank God this changed in 2017, but prior to 2017, the seller could pay nothing in closing costs, not even the title policy, not even the survey. So no seller concessions whatsoever. This is kind of rough with builders too, because generally builders will have some sort of incentive. They can't pay any closing costs with reverse mortgages. So after 2017, they did make a change that now the seller can provide the owner's title policy, which is normal and customary in Texas, and they can provide the survey, which is normal and customary. Nothing else. They can't pay for a home warranty, and they can't pay, I can't give them any credits. There's none from you as the realtor. You can't give them any kickbacks or help pay off any closing costs. You can't do any of that. No carryback financing, and no gift of equity. So the most common pitfalls with reverse mortgages is the home inspection. Now, I'll tell you another horror story with reverse mortgages before 2017. Before 2017, we used to have to, if the customer said they were getting a property inspection, you had to provide the property inspection to the underwriter, and the underwriter would just condition it for everything that is not HUD approved. So drip pans, GFI switches, all that stuff. It was a nightmare. But thank God they changed that. So in 2017, we don't have to have a copy of the inspection. But if an inspection comes up and there are some repair items that are done, oftentimes you'll ask the seller to credit the borrower in lieu of doing those repairs. Now, what did we just say on the previous slide? Would that be acceptable? Let's hear some answers.
No.
Absolutely, would not be allowed because seller cannot contribute. So if a repair has to be done, then the seller has to do it and have to complete it before closing. You can't give the borrower cash in lieu of. And then the property must meet HUD FHA appraisal conditions. And these, for us old timers that's been around for a long time, HUD appraisals used to be a horrible thing because they wanted everything fixed. It's not that way anymore. The only thing the HUD appraisers are really concerned about is wood rot, broken out windows, any health and safety issues, water damages, and if there is a pool and there is a certain amount of height above the pool, they have to have certain rails. That's the only really thing that's a really big issue between appraisals that are HUD and appraisals that are conventional. So as long as it meets those requirements, you're fine. And if any HUD appraisal, if the appraisal requests repairs, then the seller has to complete those repairs.
Okay, I got a question, Richard.
Uh-huh.
What do you mean there has to be rails around a pool?
Well, not every pool. Like for instance, if your house is on 2 different levels, let's say, your house is up here, your pool is down here, and you have 3 or 4 steps going down to it, you got to have a rail, a stair rail on those steps. That's
Rail. Okay, I was thinking of a fence around the pool. I don't know why.
yeah. No. I'm sorry if I said that, that was incorrect. But I'm talking about just handrails on steps, things like that. That's the only major thing. Sorry. So with reverse mortgages, the processing timelines are very similar to forward mortgages. Maybe a little bit longer in the environment we have right now. You might want to allow for 45 days for reverse mortgages. Since the financial crisis that we've gone through recently occurred, reverse mortgages requests and originations have gone through the roof. So a lot of people trying to shore up their retirement savings by using their equity, which is a very smart thing. So the underwriters are very pressed and squeezed, so you might allow 45 days. But to make everything run smoothly, first of all, you need to get pre-approved with a reverse mortgage, just like any other mortgage. Get that pre-approval done. Then you also need to get a counseling session done. Reverse mortgages not only require me to go over all the details with the customer or the loan officer to go over all the details with the customer, they also require an independent third party to do a counseling session with them, much like a homebuyers education class. So it's usually, you can do it in a classroom setting. In Dallas, if you request a classroom setting, it's an 8-hour day. And it takes about 3 to 4 months to get that counseling done. However, you can do it over the phone in about an hour, but it does cost about $125. So the pre-counseling class needs to be taken and completed, and the loan officer needs the certification before you go shopping. Because if you wait until you get a house under contract and you haven't been counseled, I can't even order an appraisal on the property until the counseling session has been done and a certificate is delivered. So if you're talking to your customer and you're involved in one of these transactions, make sure they're counseled before you go out and make a contract. The purchase contract is also going to have an amendatory clause. I know in the state of Texas, the third-party financing already includes an amendatory clause, but with HUD, there's 2 special amendatory forms that will have to be signed. Once we go under contract, I'll provide those forms, or your lender will provide those forms, and your buyer and seller will fill those out. Essentially, it's just saying, just like any other FHA process, if the if their home does not appraise, then the borrower is not obligated to move forward with the transaction.
Hey, Richard.
Yeah.
I just wrote a contract for a reverse mortgage, and on the financing addendum, I checked, reverse mortgage. But what is that amendatory clause?
It's just basically restating the FHA guideline that if the house does not appraise, the borrower is not obligated to continue with the transaction.
So that's an addendum?
Yeah, the lender will provide it to you. It comes with the loan documents that we put together.
Oh, it doesn't go with the offer to be signed by the buyer and seller.
If you're working with me and we know that we've got a contract come in, I can give you those forms before you actually even write the contract, and you can include them. But it's very easy. They can be docu-signed after we go under contract, and it basically just, again, reiterates the third-party financing addendum. And so the seller shouldn't be alarmed by it, because it's basically, again, just restating the same things.
Okay.
So once we go under contract, then the borrower gets to sign their loan application. Now, when I send out a loan package for a reverse mortgage, I'm sending 320 pages. It's just amazing how many pages there are. But about half of that is the copy package. And under the new guidelines, because of the pandemic, I'm doing more DocuSign now than we did before. We used to meet all my reverse mortgage customers face-to-face. Now, because of COVID, we're not doing that. So we can do DocuSign on those as well. So we get those disclosures signed just like every other one. Order a case assignment for FHA, order FHA appraisal, goes to underwriting. It's probably already been to underwriting by now, but it's going to be resubmitted to underwriting with the appraisal. We clear any conditions, it's clear to close, and then we fund it just like a normal transaction. At Service First Mortgage, we are the actual lender, so we'll be funding it ourselves. A lot of these, if you're dealing with people that are not me, they may be a broker, so you're going to have a broker involved that'll fund the transaction.
Hey, Richard.
Yeah.
Is this loan, the interest rate standard across the board, no matter what lender you use?
No, it is not. And that's one of the big advantages of working with me. When I teach this class as a CE class, I can't really throw this little plug in there. But when I was brought to Service First Mortgage to bring reverse mortgages to our corporation. And we decided when we put the loan into place that we are not going to do huge margins like our big competitors, AAG and things like that. So about 99% of all reverse mortgages that are originated are done so with adjustable rate mortgages. And if you look at those approvals and proposal packages you get from other lenders, you'll notice that the margins are 3% sometimes, 3.5% margins. What that does is that's telling that's giving the lender a ton of extra profit on that loan. I operate these loans with margins as low as 1.9 to 2.4. So the interest rate that we operate on is generally oftentimes a whole point lower than a lot of our competition. Any other questions about rates and things?
What about origination fee?
We provide options for origination fees. You can have it an origination fee, or you can not have an origination fee. The interesting thing right now, and for the long term, on a reverse mortgage, an origination fee with a reverse mortgage is just like a regular mortgage. If you're paying an origination fee, generally you're paying a lower interest rate. So with reverse mortgages, the same thing. If you're paying origination fee, you're getting a lower interest rate. If you're not paying an origination fee, then your closing costs are less, but your interest rate's a little bit higher. So with reverse mortgages as well, there's a minimum that HUD allows for the calculation of the benefit of the maximum borrow amount. And that's actually higher than the current interest rates we have in the marketplace right now. So I used to do all my reverse mortgages with an origination fee because the customer benefited dramatically from that. But in the current market, I'm doing my mortgages now with no origination fee because the customer benefits from it. Now, if it's a long time thing, if the customer is 62 years old, I would still recommend taking the origination fee and getting the benefit of a lower interest rate. If they're 90, then probably not. Don't pay the origination fee. Does that make sense?
Yes.
So basically that concludes our class today. And if you'd like to schedule a one-on-one or a one-on-one Zoom, because I don't know if you guys still want to get out there with the virus and everything, but if you do want to schedule a meeting, text me. If you want to be put on our distribution list about reverse mortgages, text me as well with your contact information. I'd be glad to provide it for you. So, Amanda, do you have any questions? Anything I can address?
No, I just want to thank you for your time today and the presentation. You are absolutely the best in the industry for specialized niche products. And the information that you send out, you guys subscribe to his information, his email, the text messages. You start to get to know Richard just as a resource. He's in it for the people aspect of this business. So if you need help, I promise you, if you need help, if you need a second opinion on something, if you need information, you need to talk through a scenario, Richard's not about the bottom line of making a buck. He will help you. He will bend over backwards. His resources will be your resources. He's an open book and he is there to help you. Make sure you become friends with Richard, subscribe to his information. It's so helpful.
Oh, you are too kind. Thank you so much. I appreciate that. All right, guys. Anything else I can do for you guys?
Well, thank you so much, Richard.
My pleasure.
It was awesome.
Thanks, guys.
And I've been in a few of these, and you give more information than anybody else. So I do have to say that.
Thank you. That's very kind of you. All right, guys. Thanks so much. Anybody wants a recording, I think I can share it with you. So just email me requesting that, and I'll get you the recording. Amanda, I see you. I'll send it to you. Okay?
Thank you.
All right, guys. Thanks so much.